Hi, I'm Megan Walters, Head of Research here at Asia Pacific for JLL.
So let me kick off with global growth is better than we expect. Global growth is accelerating and the world is looking up. If there are risks on the horizon, they are political risks and risks around the end of quantitative easing. In terms of the real estate markets, the global growth means that there is demand from occupiers. There's demand from occupiers to be in commercial real estate space. We've got strong demand from cross-border investors right across the region. Here in Vietnam, we're showing in our JLL research that Ho Chi Minh is attracting some of the highest levels of FDI in commercial construction. So let's start with accelerating and synchronized global growth. There have only been 3 periods since 1945 when we've had all major economies growing concurrently. The most recent time was actually in 2007. And the strength and speed of the most recent global growth, I think, has surprised everybody, even the World Bank, who are renowned for being really quite pessimistic, are saying that they're expecting global growth to continue. What that means is this is what the world looks like for Asia Pacific. So I'll take a moment to explain this chart. This is output measured in US dollars by the different countries. This starts back in 2002, and this is the output of the United States measured in US dollars. This is nominal GDP output. And as you go across, you can see the United States grows, the US in the dark grey. Next to it, you have the Euro area in the pale grey. And we deliberately used the Euro area because that takes out the UK. So it's not Europe, it's the Euro area, the area that uses the Euro currency. And you can see that measured in US dollars, it grows, but perhaps not as much as you might expect. And obviously the standout next to it is Asia Pacific, with the countries added up next to each other. So this is China, this is Japan, this is India, this is Australia, and ASEAN sitting at the top. And what you can really see is the degree to which Asia Pacific overtakes the other regions. So just in a 20-year period from 2002, so this growth is pretty much baked in. So what this is doing is when we talk about risk, it's actually around the political risk of Asia being much bigger and more powerful than some of the other regions, and perhaps the other regions not quite expecting or realising the degree to which Asia will dominate global growth. Because Asia is growing much faster, we can expect global growth to continue. With Asia being a bigger portion of the pie and growing faster, we can expect this picture to continue. Real estate performance in this global. First of all, urbanisation. People continuing to move to cities. This is a process that is ongoing and clearly driving demand for real estate. Above it, a specialisation, continuing outsourcing and specialisation. Both of these, both urbanisation and outsourcing, very much underpinned by technology, and which is affecting the type and style of real estate, which I'll come on to talk about. And again, all flowing through to the capital that is required to drive this real estate. So those are the secular trends driving real estate performance. What that is leading to is 3 major investment themes that we can see across the region. First of all, tech locations. Where in cities do tech companies locate? And I'm going to spend a few minutes talking about that later on. The second part is continuing allocations to real estate. There was I thought it was a very good comment by one of the FT commentators, the Financial Times from the UK, a commentator from there, who said, in the future, wealth will be stored in 3 places. Wealth will be held in brand, intellectual property, and real estate. And so part of the reason why we're continuing to see allocations to real estate is to capitalise on that trend. Because of the growing allocations to real estate, in turn that is flowing out to branching into alternative forms of real estate, things like data centres and schools, alongside the more traditional forms of real estate investment in offices and retail. And so those are sort of the 3 trends that we've got going on across the region. So before I dive into tech and what we're seeing in the tech space around office space, let's just talk about the wider Asia Pacific market. This is our JLL property clock, which I'm sure you've seen many times before. On this one, we've noted down the vacancy rates on the different cities so you can see where they are. And as you can see, very much around the region, there's activity on the growth side, with rents rising fastest actually around the 9 o'clock position. That's the fastest rent rising position. Where you have rents falling in places like Shanghai and Jakarta, they are falling because there is too much supply, not that there's not enough demand. So there's plenty of economic activity. It's just in terms of the cycle of as offices are delivered to the market, there are points where there are gluts into the market. And so you can see things like vacancy rate in Jakarta at 28%, which is oversupplied, but there is still demand right across the region. Which means in terms of our rental outlook on a global basis, the Asia-Pacific markets sit well when compared to the other global markets across the region, with in fact Singapore sitting as being one of the highest ones. As a services centre for ASEAN, the growth in the ASEAN region is very much being felt in Singapore, and the supply that we've had has thoroughly been absorbed, and so now we're expecting rent growth to climb across 2018. In terms of affordability, which is the other big question we get, is what does it look like for occupiers to be in the region? It's not all about investment, it's very much about what do the occupiers want to pay. You can see for your Ho Chi Minh and Hanoi that in fact they are more expensive than some of the other ASEAN capital markets, which to my mind as an outsider means that these cities could take more supply. You've got more demand in the city than you've got supply, hence your rents sit higher than the other markets that you've got in the ASEAN space. So, space for new supply to come to the market. And indeed, this is office demand. Here we are, ASEAN office demand, 2010 to 2015. Increasing office demand, even if where manufacturing is a strong driver of GDP growth, for every 100 jobs you create in manufacturing, it usually has a knock-on effect for about another 27 jobs in services, because the two are very related together. So if manufacturing is a strong driver of GDP for you, you will see it still driving into the services sector. So on that, I just want to take a few minutes to talk about one of the wider trends that we're seeing, which is about tech locations and where tech companies are inside the cities. This is a piece of work we did across Asia Pacific. We've done two reports, both of which online. 2 reports online. So let me just talk through the detail of that. What we did was we looked to see what types of technology company are expanding fastest. First thing we did was categorize them right across the region. The next thing we did was to look to see where they are located across the region. So if you're interested in this report, you'll see it. And I think some of the interesting things that stood out for us was in different cities, tech zones are in different places. So if you're in Shenzhen, you are going to be in a business park, whereas in some of the other cities, you're going to be in the grade A office stock. But what was really interesting was that the tech zones all agglomerate together. They all collect into the same location in cities. And the reason is, when you ask the tech firms where do they want to be in a city, or what location do they want them to be in, they will say they want to be in a location that gives them access to talent pool. That is the number one reason as to why you go to a location. Number 2 was government policy. Number 3 was rent. So it's not necessarily about the rent or the type of space. The number one reason was access to talent pool. And then supportive government policy, that kind of might be also linked to access to talent pool. If you've got a supportive government policy that gives you a tax break in a particular location, then people will start to go there. And again, it's the access to talent draws on it. So the agglomeration factor, which is the word we might have learnt in geography in school, you have to get it back out, so agglomeration really, really matters. Once you get a hot spot of sticky talent, it tends to stay. And so if you can get your building or your collection of buildings in your location to be the hot spot of sticky talent for tech, it will serve you well in the future. Okay. And it's not just the tech firms who are using so we have talent. So once we have a collection of talent that needs to be in one space, people are then spending quite a lot of money on their office fit out, and we'll come on to talk about the co-working trend, in order to attract talent. And so firms like JLL are having to compete on the same basis for the smart young millennial population. So this is our JLL office in Shanghai. It is a co-working space, so if you happen to be in Shanghai and you want a coffee and somewhere to go and work while you're in Shanghai, please come to our office. You're very welcome. This is the reception area. And It's about the attraction of talent, which is talent whether they're from our from our clients or our colleagues. I think it's about everybody working together, and this is some of the back office areas that we've got inside. So different styles of space for people to meet and greet. It's a very different picture to the old-fashioned rows and rows of desks that you might have been used to seeing. And so this leads, so the tech piece then leads into the co-working and what we're expecting the co-working space to look like. In developed markets out to 2030, we're estimating that we think that whether we call it co-working space or flex space will be as much as 30% of office markets. Here in Southeast Asia, we've scaled it back a little bit, but even then, at the moment, we think it's about between 1% and 5% of space, but we're certainly expecting it to go to 10 to 15% of space. And, you know, we may be utterly wrong by those predictions. It may be far more than that. If you think about even 10 years ago, would you have expected everybody to have smartphones and to be able to watch a film on your telephone? You might have thought no. So the speed and rate to which we might be wrong about this flex space is something we can debate on the panel later. The genius about the co-working space, the co-working operators, isn't just about the space and getting the talent together. It is about curating the experience or creating a sense of community. So the co-working operators that we think will do well going forward are those that create a sense of community, particularly in the online space. So what does it look like? If you want to go and find somewhere to go, the first thing you're going to do is look online. So what does the online experience feel for you? And then when you get there, what is the sense of the community? What is the sense of activity? Sorry. So that's in the office space. That actually leads on to retail space operating in a similar kind of way. What is the experience when you get into retail space? We've seen a number of retail spaces actually be converted to co-working spaces because it puts people in in something like a shopping mall, which adds to the footfall and adds to the sense of experience. And then in the retail space, because of online shopping, which we'll come on to talk about, people's experience inside shopping centres seems to matter more and more. And so we're seeing much greater It's always technology. So yeah, very much in the retail space about creating a community feel inside space. So in terms of the office, the retail markets around the region, again with rising wealth and rising middle class, retail is still growing, but there's very much a switch around to experience style stores and food and beverage. And then for the cities here, we can see that in space per person, there's plenty of capacity for additional retail space across the markets. As much as we expect online shopping to take off, here we are, mobile phone users and the percentage of population who are buying things online. The online space, whilst important, for retailers it's going to be about finding reasons to come into the stores. Online retail, Amazon and Alibaba are two of the sort of biggest names that we know about. So we talk about Amazon in terms of its Prime Day. It was a 60% increase from 2016 to 2017, but still at 2.4 billion compared to Alibaba at 10 times the size. So it's people like Alibaba who are changing how the retail market looks like, and they're developing what you might call a physical internet. So if the internet is the movement of packages of information, the physical internet is the movement of packages. And what Alibaba are doing is starting from end to end. They are the end-to-end process. So these are the Alibaba little vehicles that have been developed with one of the Chinese car manufacturers to form the physical internet, which will move the packages around as we move forward. The physical internet has an impact on global logistics and logistics properties. Industrial property and logistics properties have, we've seen a massive increase in the volume of investment that has gone into them. It's up 17% this year. So I just wanted to take a moment to talk about industrial space and manufacturing. Vietnam here, increasing its manufacturing competitive index up by about 5 places here, and outpacing the rate in which it's increased its competitive index. At the same time, you've seen China, in terms of its cost per hour, at about $4 an hour, whereas Vietnam still stays at about $1.50 per hour. So it's one of the reasons why you can see so much foreign inbound investment into manufacturing in this part of the world. And concomitant with that, you actually see, sorry, I can't see which one it is. There it is, Ho Chi Minh. You actually see a fall in the construction costs at the same time. So a very good reason as to why you see more money flowing into this part of the world. So in terms of what it looks like moving forward, you've got people wanting to be in this part of the world, and you've got the physical internet of moving things around. The big change that we've got coming is China. So I showed you at the start how big and important China becomes over the next 5 years. And the One Belt, One Road, and the degree to which it shifts around the need for property and where people want to be in this part of the world. So it's something to watch, and it's something that the European investors are spending time talking to us about. I was asked to go to Hamburg, which is one of the ports in Germany over here, to talk about the Belt and Road Initiative and what it means in terms of the train line that runs between China right through to Europe. I happened to be in London the day the first train, went from Yiwu, which is just south of Shanghai, all the way to London. I'm British. The UK took a vote to leave Europe, which has caused some disquiet in parts of the UK. Some British people are not happy about it, and the Europeans aren't happy, and nobody's happy. But the day this train arrived in London, there was huge publicity for this train, and I think it was because the British felt connected to the rest of the world, and very much that even if they weren't going to be part of Europe anymore, they could still feel part of the wider world. So the train is running. It will run from China all the way over across land to Europe. It takes 17 days instead of the 40 days to run. The sea route takes 40 days, this train takes 17 days. It went back the other way in April, and going back the other way it carried whiskey, multivitamins, and I think it was milk powder back to China going the other way. So it's something to watch going forward. In terms of the wider, so those are sort of some of the trends that we've got going on. In terms of transaction volumes and the state of the overall market and money flowing into real estate, we were expecting Asia Pacific actually to be stable on this time last year. In fact, Asia Pacific has come in 10% up. We just finished the numbers a day or so ago, and we've actually seen numbers going up. So we were a bit too pessimistic in these forecasts. In fact, everybody was a bit pessimistic. Europe has actually seen transaction volumes go up even more in the UK. So everybody was expecting investment into London to fall because of Brexit. Actually, it's up 32%. Because people are saying, actually, they're not too worried about it, so investment volumes are up. In terms of what sort of yields you can get on property across the region, these are typical transaction yields in the middle, and if anybody would like these numbers, we can run through them. These are typical transaction yields across the region. So places like Tokyo, 2.5%, Sydney, 4.6%, Singapore, 3.2%, and then Ho Chi Minh running at more about 8% on the risk profile that investors perceive in this part of the world, which they'll talk about some more, which means that the capital value picture is that Singapore, Sydney and Melbourne will sit at the top, and then we've got Ho Chi Minh and capital values and Hanoi sitting here. And I know that Stephen, Trang and Greg are going to talk in a lot more detail about those. How that sits then between the different sectors of office, retail and industrial. We've plotted Ho Chi Minh here for you to see, because that's probably the market that's most transparent, most comparable. The darker colour is the income stream that you receive. The pale colour is the capital value gain or loss that you might see. So here in Perth, you've actually got some capital value loss, despite the fact you've got some rental income stream coming in. So that's how it sits. So on a total returns basis, out to the end of 2019, Ho Chi Minh performing well, and right up there in the plus 10% area on a total return. Just some of the deals that have taken place this year. I think some of the biggest deals have been in Singapore, deals at well over the $1 billion mark. And then this is one of the JLL deals here in Vietnam, which we can come on to talk about. And then just to finish off, a couple of points just to say that It's great to be back in Ho Chi Minh. In terms of construction FDI, certainly one of the hot spots that we've got going on with the demand for manufacturing, the demand for services, and growing middle class wealth, which means that in terms of a city momentum index, which we put out in 2017, we're showing that a city momentum index, this is a momentum index based on 42 different indicators, everything from population, connectivity, real estate investment, economic outlook. Ho Chi Minh and Hanoi certainly sitting in the top 10 globally in terms of city momentum index. And so with that, my final slide, where can investors find value? We're very often asked, where should investors go across the region? The Europeans and the Americans coming into the region always ask us, where can we find value? And so we've highlighted there Vietnam, logistics and industrial facilities, and then we know that foreign residential development certainly attracting foreign investors. And so with that, I'd like to say thank you for having me. I'll be back on the panel later, and I'd be delighted to answer any of your questions.